Hello, Thunder Bay, and elsewhere, I suppose. Sent out a blog post yesterday about leasing, and it's already received a number of views. Thank you for those that have taken the time to read it. Wanted to do a quick video following up that written post, just in case you haven't had a chance to read it yet, and this might be an easier medium for you to absorb the message. Leasing is, in our industry, the car industry, probably one of the more misunderstood parts of the sales process. We tend to find resistance when we bring it up as a possible option for potential buyers. And when you dig into that, for the most part, it turns out to be that way because people don't understand exactly how it works, and they want the reassurance of ownership. And they think that if they own their asset, the car, at the end of their finance term, then that is beneficial to them when they trade it in. And there are certainly circumstances where that is true. However, for the vast majority, assuming that the lease rate is competitive with the finance rate, that's not necessarily the case. And we're going to go through just a couple quick examples here and explain why that might be. So, like I said, one of the largest counter arguments to leasing is, well, I prefer to own my car, and I prefer to have that value available to me when I go to trade it in the next time I'm ready to buy a vehicle. So let's take a look at that. And I'm just going to do a little bit of writing here. So if you have a $50,000 vehicle and you're going to finance it over 5 years, right? So 50,000, 5 years, okay? At the end of those 5 years, it's going to have been a total payout for you of $50,000, right? The way car ownership works as an asset is it's a depreciating asset. And the majority, or not the majority, but the largest depreciation occurs after the first year. However, after 5 years, if we were to use industry average, and it varies from manufacturer to manufacturer, of course, luxury cars might be different than, regular, we'll call it mass market cars. But for the sake of argument, the average, industry average after 5 years is your vehicle is worth about 25 to 30% of its original value. So if we take that in the middle, we use 27% as a calculation, that means 50,000, right, divided by 27% equals a remaining value of 13,500. Okay? You spent 50,000 over 5 years. It is now worth 27% of the initial 50,000. You're now left with $13,500. In essence, you have taken a $50,000 investment, we'll call it. Let's clear up the screen here a little bit. So you've taken a $50,000 investment. Let's say you gave that to your financial advisor and said, I want you to lose $36,000 over the course of 5 years. So from 50 to 36,000, that's how much you've lost, leaving you with the aforementioned 13,500 in asset value. Not a great investment. The value of the ownership, as the argument goes, kicks in now when you're ready to trade in. Now you want to buy a new car and you have another $50,000 purchase price, but you have a vehicle that you can trade in for $13,500. In theory. There are a few issues with that, potentially. The lease value at the end of the 5 years is locked in the second you sign the paperwork at time of sale or delivery. No matter what happens in the market, the remaining balance of that vehicle is not your problem. It's the owner of the lease, or the owner of the vehicle, which in our case would be General Motors Financial. If the market crashes and your value, instead of being 27%, is only 15% of the original purchase price, that has no impact on you. That is completely absorbed by the company that was dealing with the lease originally, which would be, in our case, like I said, General Motors Financial, and you get to walk away free and clear. However, if you have financed that vehicle and now own it, and the market has crashed on you, and instead of it being worth 27%, it's now worth 15%, you have to absorb that difference in original estimated final end value versus current final end value. So here's a few other things to consider about lease versus finance as it pertains to your payment. So if you have a $50,000 loan, right, that's the price of the vehicle when you bought it, and you're paying it off over 5 years, right? The math on that is 50,000 divided by 60 months equals a monthly payment of $833, right? So 50,000 divided by 60, which is a 5-year term, leaves you with $833 a month in finance payment. If you were to lease it, and remember, if the vehicle is worth $13,500, what you're paying is the difference from the 50,000 down to that 13,500, right? 50,000 down to 13,500. So all you're paying for is the difference between those two numbers, which in this case, 50,000 minus 13,500 is a total lease obligation, as it's called, of $36,500. Whereas on the finance, you're covering the entire $50,000 over the 5 years. So if you do the math on that, originally, right, 50,000 over 5 years is $833 a month. If you take a look at the lease side of that, you're now paying for $36,500 over 5 years. Okay? Where are we here? Down here. So if you take 36,500 divided by 60, again, like last time, your payment, instead of $833 a month, is now only $608 a month. You're driving the exact same car for the exact same amount of time. Instead of paying $833 a month, you're now paying $608 a month. But Marcus, what happens at the end? I don't own it, right? And you don't. That's true. But you have more options with the lease, than you do the finance at the end of it. If at the end of the lease you love the car and you want to continue to own it, you already know what your amount owing is, right? It's that $36,500. Oh, no, sorry. It's the $13,500. Right? Because that's what it was determined to be worth at the end of the lease. So knowing that, you can save up over the course of the 5 years to have that money handy, and you can buy it. Or you can just take the keys, give them back to the dealership, and move into whatever new vehicle you'd like to pick, starting this process all over again. Now, the one thing that this does, obviously, is it continues a lease payment or a car payment in perpetuity. However, it's been our experience in terms of watching trends is that a car payment is now basically a normal fact of life. Cars have been commoditized to the point where we see the average person wishes to turn around their vehicle in about 3 to 4 years. 5 to 6 is a little bit more accurate. But you have to ask yourself, if you're trading in your car, or if you're talking about having value in a vehicle to trade in 5 years' time, obviously you're going to want to get into something new. And the ownership side of it is causing potential headache down the road. You're going to have to trade it in. Maybe you won't like the trade value, or you can sell it privately, which is a whole other ball of wax, which can be a real pain in the butt. And you don't know what you're going to be able to do with that vehicle at the end of the 5 years if you financed it. Whereas with the lease, it's an easy exit strategy. And what's nice here is $833 versus $608. That's over $200 a month difference. You can bank that $200 every month for 5 years, and it probably would do better for you if you did that, if you took that and invested it in something, as opposed to putting it into a car, which at the end of that 5 years stands to only worth $13,500. There's a few instances where a lease probably may not be the best idea. If you know for a fact that your kilometers in any given year are well over 24,000, then you're not going to want to lease, most likely, because odds are you're probably going to be over the kilometer amount. The other instance where it might be worth financing and owning is if you know that you're going to be driving your car for 10 years, 11 years, 12 years, and that's just how you manage your vehicles. However, that's, as I mentioned earlier, not what we tend to see. And the reality of the situation is, if you're coming to our dealership or any other dealership with a vehicle to trade in, you are indicating to yourself that you want something new on a somewhat regular cadence, be it 3, 4, 5, 6 years. And the other issue that we're seeing is people like the lower payment, right? And remember, the lease payment was $200 lower per month than the finance payment in this example. That's not always how it's going to work out, but in this case, that's how it was working out. In order to match that payment, customers are now financing their vehicles not over 5 years, but 6, 7, in some cases 8 years. And if after 5 years your vehicle is worth 27%, let's say on average, where do you think it's probably going to fall years 6, 7, and 8? Significantly lower. And what we're finding is that a lot of people end up owing more still on their loan than their vehicle is worth. And now you have to take that remaining loan balance, because you have to pay it, and put it into the finance on the new car. So now if you still owe a balance of $7,000 on the vehicle you're trading in, and you're buying a $50,000 vehicle, you now have a loan of $57,000 as opposed to just the $50,000 for the vehicle you're purchasing, because that initial financial obligation must still be met. And eventually this becomes unsustainable, and you'll reach a point where if you go through 2 or 3 cycles of this, you probably won't be able to get out of it, and you need to ride out the 6, 7, 8 year finance term on your vehicle. Now, if you're really good with your money and you can pay it off, or you can save, then you can avoid that. But at the same time, if you know you're going to want a new car and the leasing is attractive from a rate standpoint, and the value of the vehicle at the end of the lease term is strong, which will help drive down your lease payment, because again, you're only paying for the difference between the initial value and then the final determined value when the lease is done. The lease payment can come in very, very attractive. And so we really urge that you come to understand leasing. And if you don't, and the ins and the outs of what you're responsible for and what you're not responsible for, come see us at Badanai Motors at 399 Memorial Avenue. We've got 7 product experts right now that will be more than happy to speak with you about how leasing really works and is it the right fit for you. And they can answer any of your questions. But from a financial standpoint, if you speak to most financial experts, they'll always tell you that you should not own a depreciating asset. You should lease a depreciating asset as much as you can. And a vehicle is probably the #1 depreciating asset that you will own. So we need to get rid of the myth of ownership. If you're falling into that category of financing 6, 7, 8 years, but you want to get out in 5 years, eventually that's not going to work for you. So take a look at the leasing option. It might be very attractive for you. Thanks very much for listening and watching, guys. We're going to put this up on our podcast eventually too. Remember, the blog post is up. You can find it on our website, badanimotors.com. You can find it on our Facebook page, a link to it, facebook.com/badanimotors. We have it up on our LinkedIn page as well. And we would love to hear from you. So if there's topics you want, or if there's questions or comments, please shoot us a note. Otherwise, badanimotors.com. Contact us, 807-683-4900. We'd love to help you out. Thank you very much.